Hello and welcome to the second episode of Macro 2.0. With me in the studio today is Barry Nielsen, Chartered Financial Analyst with Opportunity Bank. Thanks for being here again.
Thank you.
I look forward to the weeks ahead. We have a lot to talk about big ideas, big institutions, and big money. And on that latter subject, today we're going to dwell on the importance of the American dollar and its role in the international economy. And I'm going to start by quoting a published author. I think you'll recognize these words that were published right around Memorial Day.
Okay.
Quote, "The dollar is something we should take great pride in. It represents the success of our nation and the individuals that have made it great. The U.S. dollar is a great symbol of our economic and cultural success. It is also a symbol of great sacrifice." So what I want to focus on here is your use of the term symbol. What is it about, what does the dollar symbolize? So can you kind of just elaborate on these very patriotic comments, made near Memorial Day?
Well, absolutely. I think it symbolizes the greatness of our nation, certainly economically, and much of our economic success is a function of our system of government, that system of government that was put in place over 200 years ago, based on free market capitalism. Certainly free market capitalism and the United States economy, I believe, has created more wealth and lifted more people out of poverty and a subsistence lifestyle than any economy or nation in the history of the world. And that's something to be very proud of, and the dollar symbolizes that. It symbolizes the greatness of our nation, both economically and as a system of government as well. Our U.S. Constitution, it's a great symbol of our nation, right up there with the flag, I believe.
Yeah. So I should pay a little more respect to the dollar bills I pull out of my wallet and spend, every day. I have to say, I hadn't really thought of it as a symbol. It's a very useful tool, obviously, the money that we use to buy goods and services. But I take your point, and let's talk a little bit about how it came to be that the American dollar, of all the currencies in the world, has ascended to this level of intense symbolism in our country, but also intense importance all over the world. It hasn't been such a strong symbol of our nation forever, since the beginning. So let's talk a little bit about how the dollar came to be so significant on a global scale.
Well, I think you're referring to the fact that the U.S. dollar is what we call the world's reserve currency. That means that, it means a couple of things. First of all, it means that other nations, other central banks of other nations, central bank being similar to our U.S. Federal Reserve System, other nations that issue their own currency have central banks, for example, the Bank of Japan, the Bank of England, the European Central Bank. The majority of what we call currency reserves, and those are assets held by other central banks globally, are denominated in U.S. dollars. I think somewhere around 65% of all currency reserves globally are held in U.S. dollars. In addition to that, a vast majority of global trade is priced and conducted in U.S. dollars. So, for example, and I'll use oil as a good example. If I'm an Australian, perhaps, oil refiner, and I'm buying crude oil from Norway, the state oil company of Norway, that oil is going to be priced in U.S. dollars, and that transaction is going to be conducted in U.S. dollars. If I were that Australian oil refiner, I would have to first convert Australian dollars to U.S. dollars to purchase that cargo of crude oil from Norway. The U.S. dollar is the world's, I'll say, predominant currency.
And that's been the case since the Second World War.
Yes, since following the Second World War.
We emerged from that debacle victorious and as the largest power, the greatest power on the planet. And soon thereafter the largest economy. So I guess what I'm leading to is that this dollar not only symbolizes the success within our borders, but it also is a manifestation of our relative size and significance as a trading country, as a productive country. We may no longer be the biggest economy. China's knocking on that door, but we're still the predominant financial and economic power, and the dollar is a reflection of that relative strength.
Absolutely. As you said, following World War II, the U.S. Became the world's predominant economy and force, both politically and economically. And I believe at some point in the post-year wars, the U.S. economy accounted for over 50% of global output. And then strategically, I don't know all the details, but the Bretton Woods Agreement took place, I believe, in 1944, where the U.S. dollar was officially established as really the world's reserve currency. All other currency and exchange rates were pegged to the U.S. dollar.
Yeah. Yeah, and after that, speaking of pegging, for a long time, currencies had a basis in metal, silver, gold, and other physical commodities, but mostly, gold. And I think it was 1971 when the United States, under President Nixon, officially took the United States off the gold standard. And from that day forward, the value of the dollar is based on what the U.S. Treasury says it is. It's a so-called fiat currency. In other words, there's nothing undergirding the value of the dollar other than this array of tangible and intangible characteristics of our economy, of our financial prudence as the government. So it's a complicated basis for value that has nothing to do anymore with a store of gold that you could exchange, a piece of gold for this many dollars. I'm being pretty sloppy about describing that, but it seems like that was a major change in the global economy, and it actually boosted the dollar's relative strength in not only a symbolic way, but almost a surreal way.
Yeah, I mean, absolutely. The U.S. dollar is a fiat currency, and it is based on people's confidence in the U.S. government, our economy, the U.S. Federal Reserve, our monetary system. And there is no gold in Fort Knox that backs a dollar. You cannot exchange a dollar for some amount of gold like you once could. Yeah, well, I guess an interesting thing is we talked about the dollar as the world's reserve currency. Dollars, as mentioned, are held in foreign central banks, and foreign currencies. The dollar backs foreign currencies like gold used to. You mentioned gold, like gold
Right.
used to back
that's
dollars. But again, it's all based on confidence. It's a dollar's worth a dollar because the U.S. Treasury says a dollar's worth a dollar and it's legal tender. But that's just a matter of confidence.
Yeah. And before we end the conversation today, we'll talk a little bit about what can undermine that confidence, what would actually cause the dollar to lose its relative strength and attractiveness. But before that, let's talk a little bit about beyond the perception of the value of the dollar. How is the? Let me back up. We have a strong dollar, and we're proud of it, and it's strong in relation to other currencies. It's worth more than a lot of other currencies, not every other one. And that seems intrinsically a good thing. But there are some downsides to having a relatively strong currency. Can we address that for just a few minutes? How does it burden producers or consumers in the country to have a strong dollar? And then conversely, if it weakens, who suffers and gains?
Well, I think that's an ongoing debate. What's best for the U.S., a strong dollar or a weak dollar? And officially, I think under most presidential administrations, it's been a strong dollar policy. But what that means is the dollar is is a price. And as mentioned earlier, the majority of global trade takes place in US dollars. So if we buy oil, I'll use oil as an example again, from a West African nation,
Yeah.
and it's priced in dollars, and the dollar is strong, the goods produced in another nation, perhaps oil isn't the best example in this case, but goods produced in another nation, goods that we import under a strong dollar are cost less for us.
Yeah,
It's
we get
difficult to
more of it for each dollar.
That's right. On the other hand, a strong dollar means that in global trade, the goods that we export cost more for another nation that's importing our products. Because again, first they have to convert their local currency to dollars to buy we take payment of the things we export in dollars. And when our dollar is stronger and goes up in value, it takes more of the local currency to buy the dollars that then are used to buy our products.
Yeah.
So a strong dollar makes imports a little less expensive for us, but it makes our exports more expensive in the global marketplace.
Gotcha. And so it might be overgeneralizing, but as a consumer-driven economy, most of the vast majority of transactions in our economy now involve consumers for goods and services. Other countries are more export reliant or trade oriented. We have a big trading regime in the world, but we're not as trade reliant as other countries, like Germany, for example. So the burden on our exporters is compensated for in many ways by the benefit that we as consumers, as purchasing units, because we import a lot of stuff. So we're getting a good deal with a strong dollar compared to somebody, as you say, buying some of our products.
Well, I think we touched a little bit on that in our first episode. International trade, including the value of the dollar, in a free market is going to go work to the benefit of all, at an aggregate level. But that doesn't mean that it works to the benefit of an individual producer of a certain item that sells a certain product. They might be underpriced by a foreign competitor, and the relative strength of the dollar is going to play a role in that. Dollar policy, international trade, again, in a free market environment, is proven to work to the benefit of all at the aggregate level, but maybe not at the individual producer level.
Yeah. Okay, I'm going to switch tracks a little bit because we're always short of time. But can we just address briefly the relationship between interest rates and the value of a currency? There's an integral relationship there, and higher interest rates comport with a strong currency. Is that the right way to say it? How would you describe that relationship?
Well, you're absolutely right, 100% correct. Think of interest rates as the yield on, or the return on an asset. And if interest rates go up, we'll use the US as an example versus perhaps Japan. If interest rates increase in the US, which they currently are, our assets yield more than the return on a bond, for example, where the yield or the return of a bond is very much tied to interest rates. And the higher the yield, the higher the nominal return. So if you're a global investor and you can invest in the US or in Japanese bonds, government bonds perhaps, the yield currently on US bonds is higher than that in Japan. So global money seeks the highest return or the highest yield. And when yields go up in the US, and that's generally going to be because of a stronger economy, it's going to create a demand for dollars.
Yeah.
And that is going to, and currency markets are based on supply and demand. And when the demand increases for US dollars, the price goes up, as it would in any market based on supply and demand. Again, higher interest rates create more demand for U.S. dollars because U.S. assets are yielding, or the return on U.S. assets is relatively higher than another country. And that's currently the case. That's currently what's happening in the global marketplace. As interest rates rise in the U.S., the dollar is strengthening.
Yeah, and just to add to that, if I understand this correctly, not only is there lots of dollars being held by foreign central banks in reserve, there are also in the private market, there are dollar-denominated securities. Somebody had to spend dollars to buy the stock or the asset, and that also has this upward pressure on the value of the dollar, keeps the dollar high.
Absolutely. I think 40% of debt issued globally is issued in U.S. dollars. Again, 65% of reserves held at foreign central banks is denominated in U.S. dollars. 85% of all currency transactions globally involve U.S. dollars. The global economy runs on U.S. dollars.
Yeah. So the dollar's strong now, and it's been relatively strong for quite a while, probably for most of our viewers' lifetime. You know, we don't have experience of a falling dollar or a collapsing dollar like so many other countries have economies that collapse and their currencies collapse with them. Before I get to the last question, which is what would bring the dollar down, you know, what kind of behavior in government policy or in the economy would cause the dollar to crash or to go down in value. There's often discussion about currency wars and governments intervening in currency markets to devalue the currency in order to benefit their exporters. And then there's this parallel effect of the marketplace which causes depreciation of a currency. The value goes down, but it's not because of intervention, it's because of market forces. And I find that people often confuse those two things. And in the media often, you know, when China intervenes in its currency market, sometimes that's to devalue it. It's actually a devaluation maneuver. But sometimes other things are affecting the value, and it's called depreciation. Can you just make that a little more clear than I just attempted to? The distinction.
Well, I'll try, but I think they're very much related. As the key points you already mentioned is depreciation might be caused by market forces. As we've talked about, interest rates, the relative strength of the U.S. economy versus the Japanese economy. I keep going back to that example. Whereas devaluation is purposely is currency manipulation by a government.
Yeah.
Some governments actually do not leave exchange rates to market forces. They just say this is the exchange rate of the Venezuelan currency versus the US dollar. And that's the official exchange rate.
The act of a sovereign government.
That's right. And therefore they can move it higher, they can move it lower, or they can devalue it. And they can manipulate it by selling dollars and buying their own currency, which creates demand for their currency, which makes their currency appreciate. Or they can sell their currency and buy dollars, which has the opposite effect, which depreciates or holds down the value of their currency. And that certainly takes place across the world.
So these are transactions in the marketplace, but they're not market driven.
No,
They're driven by other desires for relative power or, you know, domestic gains, whatever, political factors.
The market still drives the price, but some government entity is controlling the demand or the supply, or creating demand or supply, which artificially boosts the price being the exchange rate.
Yeah. Well, we're going to finish on a topic that we could spend an hour on, I'm sure, or more, and that is, you know, the dollar is the world's reserve currency and has been for some time. It probably won't be forever. We don't know how long these things last. And I have to mention to our viewers that you've written about this and have some wonderful examples of reserve currencies in the past that had their run. You know, the British pound is the most recent one, but there are others that have gone out of the history books even. So long story short, or a long question made shorter, what, in your view, could cause the dollar to lose its relative strength in a sort of a short time frame? What should we be looking for and worrying about with respect to the strength and resilience, the continuing strength and resilience of the American dollar in the global economy?
Well, keeping in mind, the dollar's a fiat currency, is based on confidence. But the first thing that comes to mind for me is our federal debt. We're in a big hole. It seems to keep be getting worse, geometrically worse, perhaps, at an increasing rate. And at some point, that debt's going to have to be repaid. And there's a history of nations repaying that debt by inflating its value away, by printing currency to make the value of that debt less, to make it easier to repay, because a dollar's not worth today what it was yesterday in an inflationary environment. That makes that debt more easily repaid. I think that that's something that we need to keep an eye on, because if the only way we get out of that debt hole is to inflate our way out of it, certainly that has a huge impact on the US dollar. That has a huge impact on its status as the world's reserve currency, has a huge impact on foreign investors' confidence in our monetary system, in the policies of our government and our economy. I think that is a longer-term threat to the status of the US dollar as the world's reserve currency.
Yeah. As I said, we could go on and on about this, and I know you could, and we will. In a future episode, we'll actually be focusing on debt and deficits more acutely. But for now, we're flat out of time. Thank you, Barry, again, for being here and sharing your knowledge with the rest of us. And we hope you return to this series called Macro 2.0. We'll see you next time.